It is that time of year. Everybody's starting to think about how their adjusted gross income is going to line up, where their normal tax brackets are, and sharpshoot. And if you are one of those who would need additional passive losses, this fund is designed to do that for you as well as get you great returns. The quick executive summary, then we'll get into the investment, the people, and use cases, because this is one of these more technical investments. Definitely, if you're needing tax pals, it makes a lot of sense. But it's important to use it strategically. Projections here. Here are the investment tranches. There's going to be a tranche for investors coming in 2023 and then 2024, because the bonus depreciation is going to be changing. Here in the middle, we have a sample investment of $52,000. And the preferred rate of return will be 24.9% per year. And this will be paid out on a monthly cadence starting in the 5th month. So you're going to get 84 preferred monthly payments. In the first year, we project out a preferred rate of return of 24.9%, which on a $52,000 investment means approximately $12,948 per year. And this is, of course, monthly payments broken down about $1,000 a month. And this will continue out for 7 years for a total sum of $90,000. Now, on top of that, the big reason you would be going into this particular investment is for the tax benefits here. Same minimum investment, $52,000, you can expect to see a first-year loss of about $41,000, approximately 80% of what you put in. And this is coming from the aggressive depreciation that is coming in that first year. Of course, we eventually get to a point where we depreciate the asset completely, where you depreciate the remaining $10,400 here. But this comes trailing in after that first year. And this is really where you need to be strategic on how much do you invest in this one project. Everybody's different. Everybody's got different personal situations here. How much passive activity losses do you need? If taxes is new to you, please reach out to us via email. We can send you a couple of great videos and articles with some of our CPA support staff. We gave great talks about understanding the differences between ordinary income here on the left side and passive income on the right side. Now, just to give a quick review, ordinary income we try to get away from. This is what comes from 1099s, W-2, basically our active income. The reason why I think a lot of us invest in real estate is these rents and income from syndication deals or longer term holds. This is passive income. And the reason why we like it is there's a ability to zero out passive income by these passive losses, which you are getting from this particular tax PAL fund, right? So for every $52,000 invested, you're going to get $41,000 back in losses your first year, and then the rest in subsequent years going out to year 7. So this, again, this $10,000 is cumulative of years 2 to 7. The big one is in the first year. Now we have Tranche B here, which is the 2024 bunch. And if you're investing later on, you're going to be investing in a different tax climate. Namely, the bonus depreciation is going down from 80% this year down to 60% in 2024, which is why the approximate first year losses is going to be a little bit lower in the 2024 tranche. So try to get into that earlier tranche if you can. That said, not a huge difference, right? The pref, you're going to get that monthly pref here. So that's great and all. And you're going to get the remaining of the depreciation in subsequent years, regardless. What we have here with this, depending on when you come in, some investors are always late. In this case, it really makes sense to get in there early before all the 52 allotments are taken up. So getting back to understanding taxes here, say you maybe an asset sold or you're selling off a rental property and you need $120,000 of losses because you're going to have a capital gain and depreciation recapture of $120,000. Of course, you go look at your 8582 form to see how much suspended passive losses you've got built up prior. But say you don't have any. At this point, you need to take a look at, by investing in this project, how much passive losses you'd be able to get that first year. And of course, work with your CPA here. We're not giving any tax or legal advice. But if you invested in three $52,000 allotments, that would provide you a healthy amount of passive losses to negate that passive income that you're going to be getting this year. You can also load up on passive losses for next year, right? If you're somebody who likes to plan ahead. To take this even further, so passive losses are used to offset passive income. It cannot be used to offset ordinary income. There's a line here. There's a sort of a wall here blocking that. That is, of course, unless you have real estate professional status, which essentially unlocks the ability for you to use these losses to offset other ordinary income. So we'll get into this in a future slide on how some investors are doing it. For those of you guys who are already doing real estate professional status on your taxes, you understand where this is all going, right? Load up on these passive losses to drive your income down, your AGI down to whatever you would like. This is the 2023 income brackets here. What a lot of investors will try to do is try to get down under this $360,000 for married file jointly filers level. I can mark it by this red line here. The reason being is when you go from this level to that level, you see how the tax brackets really jump up from 24% up to 32%. We have a lot of high income earners making over $500,000, $1 million plus. A lot of these guys will use multiple strategies to get themselves to lower their AGI to in turn pay less taxes. And by investing in the tax pile fund, you're able to accumulate these passive losses. And I'll highlight here, the mechanism behind these passive losses is not particularly real estate, where when you sell the asset in real estate, you have to recapture those losses. What we are using here is section 179, which is depreciation of equipment. And since we are scrapping the equipment at the end of their lifespan, 7 years, we do not have to recapture these losses. So this is the most cases, especially real estate projects, we're deferring the taxes to the future, which has obviously great benefits in terms of time value of money. But in this case, this is the closest thing to absolutely canceling out the taxes because of this aspect of us not having to recapture these losses that we get. So we went on all of that pretty quickly. To wrap up the executive summary here, we'll go into this in much more detail. But what are we investing? What is the mechanism here? This is not a real estate investment per se, although perhaps you could consider it a real estate investment since it is a series of about 2 feet by 2 feet pieces of real estate that a ATM kiosk, a running business, operates on. So our core strategy is to participate in mature and stable ATM kiosk spaces that historically demonstrate strong operating margins while also capturing margin with cash management and future fintech services. The fund controls tangible collateral, hard assets there of ATMs, which qualify for bonus depreciation and will be shared with investors, along with the revenue. So what kind of revenue, you might ask? From a variety of sources, first being the cash management services. Think of in terms of the vendor on site, the deli owner or the convenience store owner who will have one of these ATM kiosks in their establishment. Instead of them hiring an armored car to come carry away the cash that they have, because they don't want to carry too much cash because it's a danger for them, they can deposit it into our ATM and use the services that way. They can also use smart safes and also other reporting services here. For those of you investors who like hard assets, tangible assets such as real estate, this is really no other, right? We are buying these very expensive ATM kiosks, which is the hard assets. So if anything were to happen, we can sell the asset before its serviceable life ends and recoup some of the assets there. So very different than any other business, especially e-commerce businesses that sell services or subscriptions, where there really isn't hard tangible asset at the end of the day. Most of the money is going to be coming from the different fees that ATM machines make. Namely, whenever you go to an ATM machine, you have to pay like a few dollar surcharge, right? Where we get a percentage of that. And that is really where the revenue is coming from to pay a preferred rate of return, where basically at 24.9% per year, we're going to be getting our initial investment back in 4 years. So there's a tremendous aspect of, if you're thinking about risk, once 4 years gone by, you've taken your risk off the table. So if ATM machines are new to you, don't worry. It was new to me several years ago. We actually had one of our earlier investors go into this type of business. I believe the gentleman bought a few of these ATM machines. Great example of an investor kind of taking more of the mom and pop route, buying a few of these things, servicing it themselves, running around with big stacks of cash. Of course, in our fund, we're going to be working with more of an institutional partner for our operation of these assets, who has gone through all the credit checks from the bank, sponsored by a bank, and operates thousands of ATMs and has been doing it for quite some time. Many of our investors within our club has worked with them in the past. If you want to access that podcast just to get a grassroots understanding of the business, check out podcast number 268. This was published back in August 31st, 2021. Again, that's the mom and pop version. We are obviously doing this with a much more institutional operation. Number 2 here, details of this fund. So why invest in this tax file fund? First, great consistent cash flow, 24.9% per year, paid monthly, starting 4 months after we close on the asset. And you're going to have to wait a little bit more than a quarter, but at that point, you should be getting 84 timely monthly payments of 24.9% per year, meaning in about 4 years, you're going to have your initial principal back. Number 2, protection. Distributions are paid back on a blended performance of several thousands of ATMs, so not just a single ATM machine. The ATM machines represent hard assets. So in case there's something that goes wrong, we sell the assets and salvage that capital back. The third reason, I think the main reason that attracts a lot of investors in the first place, which is why we've placed this in our tax PAL fund, is that the ATM machines are fully depreciated through 7 years. Of course, the biggest pop comes in that first year due to the 80% bonus depreciation in effect up until the end of 2023. And this is where everybody needs to look at their own personal situations. If you want to talk more about your particular case, let's jump on a call or come to office hours, which I do first Saturday of every month. We can talk through these situations. And I think the biggest game changer, and where this has a huge leg up on traditional real estate, is that there is no recapture of the depreciation at the end of the investment. What we're going to be doing is scrapping the machines at the end, and therefore we don't have to recapture it. Whereas if you buy a piece of real estate, you depreciate it over 27 years, or even if you do a cost segregation, you get a lot of the depreciation the first year. When you sell that asset, you have to recapture that. Not the case in this particular fund. And the last thing here is the less risk, and we'll get into the operation in the next slides. But ATM machines are recession resistant, and the transaction fees can be adjusted with market conditions. And this is where right now commercial real estate has been beat up, and until interest rates lower and the buyers come back to the markets, I am on the search looking for more recession-proof investments. Now, on one hand, what is a recession-proof investment, right? Things that are around irregardless of economy. And I think this is also something that high net worth investors think about, and they call non-correlated assets. Non-correlated assets really represent things that don't really go up and down or influence with the economy. You can also take this and look at it from in terms of what things perform well in recessions too. And I think you could probably put this ATM fund in that category. Certainly things like short-term rentals would be things I would personally stay away from. Think about it. In recessions, people going on vacations, staying in that Airbnb, VRBO, or something that they would probably put off. And for more understanding on this is coming from Mueller Real Estate Finance, published in 2016. The theory that a lot of real estate investors, all investors in general, kind of have this idea. And if you haven't seen this before, I'll try and explain as best as I can for you. But basically, it's saying that real estate or any investments have four basic phases: recovery, expansion, hypersupply, and recession. It would be nice if things just went up and up in price, but we all know that's not the case. This is why we all invest in real estate, because it seems like the ups and downs aren't as extreme as stock market, for example, which I think most of us are used to those ups and downs. But even in there, you have the same four phases. So Dr. Glenn Mueller, he's a notable expert in real estate cycles, economist, and he identifies these phase transactions is crucial. When one door opens, another closes. It's like for myself, right? Like for a lot of our deals, we invested in the right time prior to 2021. From 2021 to 2022 probably was not the best time to be buying. And I would say officially 2022, we cut all purchases once interest rates started to hike up. And even at this point, it's very hard for me to make deals work. Even with prices coming down, the current loan environment requires myself to come in with not 70% loan to value, but 55% loan to value, which essentially kills my numbers. I can't make that work with bringing in so much equity at that point. Again, even at lower price evaluations and getting discounts on properties. Of course, every individual deal is on a case-by-case basis. There's different strategies, right? Opportunistic, value add, core, development, or plus. I'm just talking in generalities here. Different strategies based on where you are in the market cycle quadrants and actual what assets you to pick up. It's also important to note on this chart, you have things spaced out very cleanly, but typically going to have unequal durations, and this will vary by geographic area and asset classes. And diverse portfolios essentially balance the highs and lows. And I would also argue spanning time horizons. What most retail investors will do in difficult times is not invest. And I would encourage people to take a self-inventory and identify if that's what you're doing. What you really want to be doing is dollar cost averaging over a long time horizon. We have a lot of investors that had a lot of the deals before 22, and they were totally fine with their portfolio. Unfortunately, for investors getting started, you're going to be a little bit exposed when you're first starting out, the ramp up phase, especially in this tax pile fund, right? If you're able to greatly lower your taxes in year one and recoup your principal by year four, you're going to be able to drastically take your money off the table and get security. But also think about we're talking about here is think about the asset class that you're investing in. I took the time to create a little chart to mind map this out for you guys. Of course, this is general information purposes and does not represent the official stance and opinion. But I split apart all the common asset classes that we talk about here and on the same cycle, right, up and down. Some particular asset classes go through soft landings, others go through hard landings, such as office right now, which had a fundamental change in the way people use office coming out of the pandemic. Right now, apartments and a lot of other commercial real estate is going through their down phase, and I would argue going through its soft landing. However, nobody knows. It always seems like until you've seen all the bad news and your mindset and your hopes are at its deepest point, which could mean now, could have been in 3 months ago, 6 months ago, we don't know. They say that is the point where you start to come back up. And the funny thing, what I see is once things really get ticking where this upcycle already, this is unfortunately where most retail investors will start to jump into place. And this is where I've said it before, when one door closes, another one opens, right? And you need to search around and not fall in love with just one asset class, but also look for other asset classes or other investments in particular that are possibly on the other side of the spectrum and also totally immune to these market cycles and possibly being a non-correlated asset. We'll talk a little bit about the clientele who will use the ATM machines, but I would probably argue that it doesn't even fall on this particular up and down wave. I think if anything, it's pretty market cycle resistant, which is why it was one of the first things I fell back to invest my future dollars in this point in time. let alone at least for this year. And I think the way most investors will look at this investment is how does this help me this year for taxes in particular? So let's break down on how are we making money? How is the asset making money for us? Let's analyze this. So these are the traditional sources for revenue. First, the surcharge and interchange fees, typically about $3 to pull cash from an ATM fee. And if you think about it real roughly, there's a revenue split, individual contracts for each ATM, which is set up by the in-house property management company, where the split with the revenue goes to the location. Essentially, we are subleasing a 2x2 foot space there. The operator management takes about 40%, and then we investors take about 30%. So pretty much $1 of that $3 transaction goes to each of these three parties. There are also fees incurred, or of course, for us, this means revenue for digital currency conversion, converting from foreign currency into USD, and then also branding. So regional or national banks paying about $50, $200 a month for branding in strategic locations. And what we've seen is a lot of these big banks pull back from a lot of these ATM satellites, not in their brick and mortar stores. So this also poses a big opportunity for sophisticated players like us to expand the portfolio and to get more economies of scale. So those are the traditional things I think most of us are aware of. Now, what are some other things that are on the horizon? So these are the new ATM bank-in-a-box sources. First, cash management. And this is more from a viewpoint of the merchant or the person who is lending out their 2x2 space, or maybe the other business owners on the block, to use this particular ATM as a way to deposit their daily revenue and manage their cash. And of course, pull cash from at a fee, because for them, it removes a huge security transfer logistics nightmare of paying an armor car to haul away their cash. For them, all they got to do is walk over a few feet, or maybe they got to go down a block or two to our ATM and put the money in. And then at that point, it's in their bank account and the liability of getting robbed goes away. Number two here, money transfers. Number three, bill paying. The four, depositing. This is something personally I like to do. I don't like to walk around with too much cash. I always joke that I always only have $20 on hand, so that when my wife wants to buy something, I don't have any money. But it's honestly because I'm just worried about getting robbed too. So I always on the lookout for these ATMs that I can deposit cash into to get it out of my wallet. Number five, now this is a big one that could potentially lead to more sources of revenue, which is the paid fee to purchase cryptocurrency. This is obviously the trend in the future, even though 2022 was a bad year for the crypto. But I think we all know that this is coming in the future, and these ATMs, the hardware is there and it's programmable software. So it can develop in the future as these technologies emerge. So we can stay up on the current times and collect that revenue. And finally, prepaid cards. I think a lot of us don't understand that a lot of people out there aren't able to qualify for credit cards, and therefore they'll use these prepaid cards to load money on. I know some landlords, what they'll do is because their tenants don't have bank accounts, don't have checks, a lot of people who are unbankable, they don't trust these types of those big banks, nor can they get credit cards. What some landlords will do is they'll give their tenant a card to pay their rent with. So what they'll do is they'll go to one of these bank-in-a-box ATMs, put their prepaid card, which is owned by the landlord, put in their $600 or whatever the rent is per month. And then that's the way that they're essentially transferring the money over to the landlord. So these are just some of the ways that we make revenue from this investment that in turn pays us our pretty nice 24.9% pref every year, which I would probably say is maybe double or quadruple what you'll see in any type of real estate. Next thing here, who is our customer? So what we call a lot of the customers that will come and use these services isn't particularly the investors here or even myself. A lot of the users are going to be the unbanked individuals. And here are some demographics here for you guys to take a look at. But essentially, lower income folks, immigrants, called unbanked or underbanked individuals, people who use EBTs, people with minimal credit, and believe it or not, makes up over 1/3 of the US population. And I think this kind of goes hand in hand with a lot of our big investment thesis of investing in workforce housing, because this is a big majority of America, and this need is not going to be going away anytime soon. And of course, the other portion, especially for the cash management purposes of the ATMs, are going to be the merchants, the people who use these ATM kiosks for cash deposits, eliminating armored car pickups and bank runs. And they're able to use these for other cash management services, such as handling shift funds, splitting bills, providing change, and reducing registered cash too. But as you can see here, most of the underbanked people are people making under $50,000 per year. You might say, I don't use ATM machines unless I'm in a pinch. I just use my credit card and get my points that way. Yeah, I personally do that too. But again, you have to realize that 1/3 of the population are definitely not in your category with that. And I look back, and when I used to own rental properties in Birmingham back in 2012, 2013, I finally went and visited Birmingham. And for me, it was a big culture shock, because I would go there and I was be looking at these at the time. I was there like $70,000, $80,000 properties. I'm like, wow, I never realized people live in places like this. And people would have their tied up dogs outside as guard dogs. For me, it's a huge culture shock for somebody living in Seattle at the time, or anybody who lives in $1 million homes. How different this country is from one side to the other side. But in reality, the majority of people are in this lower middle class demographic. And we're the crazy ones who live in $600,000, $700,000 plus homes and live these lifestyles with incomes over $100,000, multiple six figures. The US ATMs out there, this has been increasing every single year. And the experts predict that this is going to continue to increase. This particular investment, you're going to get that big pop in terms of tax benefits that first year. In these projections, I try not to quantify what that means for you. But if you're in the highest tax bracket, especially if you live in the state of California, right, and you're going to get $40,000 of losses that first year, you may be able to turn that into a $15,000, $20,000 net benefit to you after taxes. And you get your paid your 24.9% that particular year. There's a tremendous benefit to this. And also from a safety standpoint, if you're somebody who thinks, I don't know where this graph goes after the year 2028, think about like this, it really doesn't matter, because the asset, you're out of the deal in 7 years anyway, where the ATM machines are scrapped at that point. And you've already recouped your initial investment from a only pref side in the 4th year. Now, if you contribute the tax benefits that you're getting, you may be able to argue that you're getting a total recoup in your principal by the 2nd or 3rd year. So really, all we really need these ATMs to be in this country until 2025, 2026 here. Of course, that's a pessimistic point of view. I would probably argue that the ATM usage is going to keep extending, at least for another decade. Again, answering the question, who is our customer? Now, this is a property that we purchased back in 2018 that we went full cycle on. It was definitely a Class C clientele in Texas. Here on the left side is what the kitchens looked like before, certainly Class C. And then we bumped it up to somewhat of a nicer Class B here on the right side. In this particular property, we had heavy delinquency. Even at the end, we were at 80% economic occupancy, meaning 1 out of 5 people just didn't pay. A lot of these people were just underbanked side of the community. In fact, a lot of people in this community, even the good paying ones, fell in this clientele of people just running their finances, not through a traditional bank, but just cash only or with prepaid cards, because they can't qualify for the credit. Great example of, again, reminding us all that we're very fortunate to be in the economic positions to be. And there is a big amount of Americans in this clientele for ATM machines. So I've been on the fence with this particular investment for quite some time. A lot of investors within our community have been investors in the past and great remarks on it. And I've always been hung up. It takes a while for me to get on board with things. I need to see people within my community that I trust have good results. And I want to obviously break down the investment and the user base myself. Here I did a little bit of a SWOT analysis, which I'll go over real quick here. Strengths, the technology advancements, the improving technology, like I said, the hardware stays the same, but the software can be reprogrammed to made more efficient and able to change with the times as the customer demands change. Being able to work alongside in a established partner here with a in-house property management company, we're able to get the economies of scales, take advantage of a lot of their technology gains of operation, and also troubleshooting the ATM machines, which is also under their scope to take care of as the property management side. Also, going through the pandemic was a big test for a lot of asset classes. And in this particular case, these ATM machines definitely paid the pref through those uncertain times. As far as weaknesses, we want to give things a fair shake. And it's something I want to be transparent with all investors here. I would say definitely due to security concerns, it can create some operational challenges. Things break and you're going to have to send a technician out there. And these are things that kind of go on within the business. And then from an investment standpoint, the aging infrastructure. But I think we've adequately underwritten this aspect to assume that after year 7, after the serviceable life of these ATM machines, we're assuming that the asset is not worth anything at that point. And which is why there is very little, I think maybe $500 coming back at the end of the investment as that scrap value. Number 3, opportunities. And if you're not moving forward, some people say you're moving backwards. So it's important for this technology and this business to expand. And those are increased manpower costs out there will trend towards a human-less options. You're already seeing the banks cutting hours and pushing a lot of their services to automated machines, such as our ATM machines. Also, something to be aware of is a lot of large banks are decreasing their ATM portfolio sizes. Sure, they're going to have their Chase Bank or Bank of America is going to have their ATM machines on the brick and mortar sites. So what they're doing is decrease those off-site ATM machines that are owned by those large banks. And what they're doing is they're releasing their institutional hold on the industry. And this is where operators like us are going to be coming in and picking up that let go business from their side. Now, the reason why they're letting it go is the way they feel is like it's a little bit too operational intensive for them. Think about it no different than a big REIT wants to buy very stabilized, very clean Class A asset. They're not in the business of operation, certainly not in the business of improving the property, doing value add. Again, big institutions are lazy, right? They don't need the extra returns. What we're trying to do here is pick up on the vacated need. And if it, yeah, sure, it takes a little bit of sweat equity. But I think this is what's great for passive investors. No, we're not recruiting you guys to run around with wads of cash to refill these machines and to troubleshoot them or anything like that. What we are doing is empowering a sophisticated property management team to go in with their technicians and our contracts with the armored vehicles to go and do this more on an institutional, sophisticated level with scale. And other opportunities, I mentioned this before, but the currency transactions, like this could be a huge opportunity for us and could be very cheap to switch over, especially with being able to reprem the hardware. Some threats out there. The rise of digital banking and mobile payment solutions might reduce the demand for cash withdrawals, potentially leading to a decrease in number of ATM machines. This is certainly happening in Europe. However, I'll get to that at the end. There's a bunch of different nuances why the United States and Europe are very different here. But again, the people using these, even with the rise of digital banking, is the underbanked, that bottom third of the population. And of course, another threat would be different municipalities creating laws to restrict fees on ATMs. This will probably be in your more bluer, more progressive states like New York, where they may say, we're only going to cap the ATM fees at $4, for example. Of course, we'll get into the profile of the portfolio here, but well over 35 plus states. So I think we've got that covered here. And I certainly think that, and it goes to this last point here, investor actively short time horizons, with meaning that, hey guys, we're just in this for 7 years. You're going to recoup your principal back in the 4th year. And I don't really see any type of federal laws being put in place to restrict ATM fees. I highly doubt that you're going to see it in more of a handful of municipalities out there. Further expand on the kind of the risk profile of this investment. Great cash on cash returns. Because of the high cash returns offered in the investment, it drastically decreases your investment. And I think for traditionally value add multifamily, you would see maybe 5-6% of cash flow coming out every year. And if a project lasted for 5 years, you might see about a quarter over a third of your principal coming back at you in that time horizon. And that would be a mechanism for getting your money off the table, de-risking your investment. Where in this ATM fund we have here, you're getting a quarter of your money back. So meaning that you're playing with house money in 4 years, not even including the tax benefits that you get in that first year. So by getting your capital back to you as soon as possible is the biggest indicator to de-risking your position. Next here on the left side, there is no debt to be used. I think a lot of people are concerned with interest rates, where they're heading. The fund will not use any debt or leverage, which reduces the downside risk profile. But please note that investing in any private placement deals involves a high degree of risk, including illiquidity and principal loss. All risk factors are disclosed in detail in the subscription agreement. Of course, take a look there. But I think that takes a lot of the variables out of this investment, or at least the things that we cannot control, right? Which are interest rates there. Upper right-hand corner, geographically diversified. Just one municipality like New York says you can only charge $4 per ATM fee. That's fine because we're in well over 35 plus states, and with a big focus on the Northeast and the Southeast regions of the United States. And as far as track record, these ATMs has historically performed very well through current economic uncertainties, namely the COVID period. And we expect to continue to pay throughout the recession that a lot of people are saying is coming up in 2024, 2025. Let's get into section 3 here, meet the team. So our operating partner here is Prestige, who's in-house property management group Paramount. And so these guys offer cutting-edge services such as ATM placement and operation. And they are the ones that are going to be working the contracts with the individual landowners. So a lot of business development in there. And then once the ATMs are in place, then it moves to more of an operation. So they've got a site up in Pennsylvania where they service the brokered ATM machines and working hand in hand with the banks. There's a lot of approval processes. There's a lot of audits by the sponsoring bank so that we can tie into the big, think of it as the ACH network. There's a lot of security checks that kind of goes in for us to allow to get onto that network. Myself, a lot of you guys know me, mostly background in construction and real estate. This is definitely a project or a fund where I rely on my network to kind of source these types of opportunities, namely the right people. And our legal team here, Dugan Kelly, who's done a lot of our past private placements, is also on board. So let's talk a little bit about the track record of the operator here. So solid management team with over 100 years of combined ATM experience amongst their senior management team. This is positioned well to get really prime ATM locations. And as the saying goes in real estate location, it also goes for the same. They are one of the top 5 ATM owners and operators in the United States, with ATMs in 35 plus states. They've obviously been operating longer, but in 2012, they started their first fund where they pooled together these ATMs together. And since then, they've raised over $400 million in capital, and they purchased more than 25,000 ATMs. By coming in at this point, you're able to jump on the bandwagon and get the instant diversification of not one or a dozen ATM machines, but thousands of ATM machines. And this ensures that you're getting geographic diversification too, because some locations will outperform, some will underperform. But this is what's nice as an investor, you're getting this pool of performance. The reputation of the firm being one of the top 5 ATM operators out there, it's able to get us into better than average retail locations for places like Walgreens, Walmart, Sam's Club, Exxon, Sunco, and Texaco, as well as many other Fortune 500 companies. And the asset management side is operated by Paramount Management Group, which is a sister company to the operator. And you'll see this a lot of times in even real estate companies. Like you may have self-storage company as the private equity side that we are on, but then the customer facing side where all the little complaints coming from individuals, the public out there come from. Very similar to, I think, what you've seen. The wealth elevator is more of the public facing face, more our education side where we do the family office group mastermind out of, but we do have the operation side for particular projects and deals, right? To separate the two. Here are some other properties that I've been invested in the past, mostly Sunbelt states. And obviously now with the ATM machines, we're not going to put all the ATM machines up in here, but mostly concentrated on that eastern side of the United States. Some other projects I've been involved with more and more these days into developments. These are the views at Chase Creek. This is completely stabilized now. If you guys want to take a look at the finished product, at least, then you can take a look at the video here or send the email. Some other projects that are currently under construction, underway right now. This is as of August. This is 360 unit multifamily workforce housing. But in fact, we will actually bring in an ATM company to put in the ATM and get some revenue share from these types of vendors to put into the clubhouse. And now that you all are aware of like this ATM business, not due to cognitive dissonance, now you're going to start to see these unbranded ATM machines all over the place. Of course, if you see the big logo on the side, Chase Bank of America, or that whoever's ATM that is owned by is getting marketing revenue for that. And then you'll probably look on the side of the ATM and see who's the management company from there. Of course, some of you guys. But here, let's get into some of the use cases, right? Because we went over the investment, we went over the returns and the tax benefits, but how does this kind of play in people's individual situations? And I'm going to preface it that everybody needs to talk to their own CPA. I'm not a tax attorney, I'm not a CPA, but this is hopefully to just give you some ideas. So here on the left side, this is actually a screenshot of my tax form back in 2017 when I sold off 7 of my rental properties back then, and I was going into syndications and private placements personally. The bad thing about selling rental properties, even if you're making a great return, which you have to pay those capital gains on, is you have to recapture all the depreciation that you took. That's just the nature of real estate. And a lot of people within our world don't really do 1031 exchanges. As I say, they're a little bit obsolete in my opinion. The better way is to do what we call is a lazy 1031 exchange, which is to invest in real estate deals to accumulate passive activity losses so that when you finally do incur the big capital gain and depreciation recapture, which I would say is on line 13 here on this tax form, you're able to offset it with the built up suspended passive losses that you have, namely line 17 here is what I did, right? I was investing in syndications and private placements prior to, and I was able to bring over $200,000 of passive losses. Here's a few different examples here. Somebody selling for $1 million. They bought it for $1 million in 2006. So not much capital gains there, but they did take a bunch of depreciation. And therefore, this person's going to need about $258,000 of losses to offset their capital gain and depreciation recapture. And therefore, where do you get these losses? That's where the tax PAL fund comes in. You invest in the tax PAL fund, you get about 80 cents on the dollar their first year, and you're able to use that to offset your passive income. So again, if you guys wanted to walk through on this more on your personal level, feel free to jump on in office hours first Saturday of every month. we'll move on to this other side, right? So now we're getting into real estate professional status. Now, we're not going to get into how do you get real estate professional status. Namely, you or your spouse needs to not have a full-time job, and you need to have some sort of active participation to justify the necessary hours to get real estate professional status. But I would say maybe a third of our investors are implementing real estate professional status to do something like this, which might be a little bit of exaggeration and made to be somewhat fun example here. Say you have a high income earner who makes $1.2 million adjusted gross income. They might to conservation easements, which is getting a lot more riskier these days due to the omnibus bill. But nevertheless, this is just an example here. They might use that to drop their AGI to about $800,000, still pretty high. They'll implement real estate professional status so that they can use their $600,000 of passive activity losses to drop their adjusted gross income down $200,000 and pretty much pay very little taxes, probably less than most of you guys pay out there. They go on a month-long summer vacation because this is the life of a passive investor, right? You've worked hard and you've invested the right ways, and they have a deal that cashes out. Shoot, it doubled their money. Unfortunately, they have to pay the capital gains on that and the recaptured depreciation on it. So now their AGI goes from $200,000 estimated back up to $500,000. And because these guys were one of these people who doesn't like to pay taxes and they opted to pay zero taxes in the past years, they depleted their suspended passive activity loss bucket. Most investors will find that their passive losses increase over time and they have more than enough when particular deals exit. But this particular investor is playing it a little bit more aggressively, where they ran dry on suspended passive losses. So they need to look around for deals. And in particular, they like this tax PAL fund because they know with a good amount of certainty how much passive losses they get. And in addition, they get a quarter of their money back in returns every single year on top of that. But right now, they're looking at more from a tax perspective. So maybe they put in $400,000 into the tax PAL fund. They get a little over $300,000 of suspended passive losses to drop their AGI down to $100,000 level. And they call it a year and start planning more vacations. And this is just made to be a fun example of what's possible. And of course, consult with your CPA. And the analogy that I use, the bow and the arrow, real estate professional status is like the bow, where if you don't have the arrows, which the arrows are the passive activity losses, you can't really do too much damage. Also, if you just have passive losses, sure, you can lower your passive income and offset other income in your portfolio and other exits on other passive investments. But unless you have the bow, that's where things get really fun and exciting, where you're able to drive your ordinary income down too. So that's where I'm like, man, like in terms of wealth building, having the ability to have real estate professional status, essentially accumulate as much passive activities as you want with that. And the key thing here is within the tax PAL fund, you don't have to recapture these losses. This allows you to drastically decrease the amount of taxes. So if you're making better than average returns, but more importantly, the drag on those returns is a lot less because you're paying a lot less in taxes, or at the very least, offsetting or paying half the taxes on your W-2 day job income. This is what expedites you to financial freedom a lot quicker. And that's where the little joke comes in with the Avengers. Everybody makes fun of Hawkeye with his little bow and arrow set. But in terms of wealth building here, the bow and arrow set is very impactful to you expediting your path to financial freedom. And this is what I talk a lot about in the Wealth Elevator book. Higher net worth people understand these types of strategies and how they all play together. And where the tax PAL fund may seem cool from just a straight up 24.9% a year pref, recouping your money in 4 years level, some of the more sophisticated investors are zeroing in on that tax benefit side and figuring out what they need this year and also planning ahead, right? Knowing that bonus depreciation is going to be phased out these next several years, maybe grabbing some for next year. So here are, again, a couple of cases that you use the tax benefits from the tax PAL fund that you're going to be getting. And to zoom out a little bit, here are 4 additional use cases on how to holistically use this with your entire investment portfolio. So starting here on the upper left-hand corner, comboing this with infinite banking or accredited investor banking that we put together for our clients. If accredited investor banking is new to you guys, check out our free e-course on it. It takes a few hours to go through, but I think it gives a general idea on how you create a policy, you stuff it with cash, and you take a loan from the policy and you start to invest and create this double dipping effect. And what better double dipping effect than to get a 24.9% return in the first year to pay your IBC loans off with that. So typically an investor will fund a 6-year policy with $100,000, $250,000 a year. You'll capitalize on the arbitrage from the rate difference between the preferred rate interest and the loan interest between there. A huge delta. I think most people these days are paying 5% loans on their life insurance. And here, probably 4 or 5 times greater than that here. So you're going to be making a great spread, as well as establishing your life insurance, your family vault for years to come. This is a good situation now because deal flow has been slow. We really stopped doing new multifamily value add deals as of summer of 2022. The Taxpayer fund with a 24.9% pref is coming at a good time and a great way to start your infinite banking policy in the beginning, or at least wait for some other deals. Some investors might combo this with more longer term 3, 4, 5 year development deals that will take a little bit longer. You don't have that cash flow today. By going into these 2 types of investments, the Taxpayer fund, which is a little bit more quicker short-term gains in the short term, and development, which are higher but take longer term to come through, makes a good blend for your portfolio. And the Taxpayer fund can also combo with college savings for kids, especially if your kids are older and you're in the age where your kids might need the funds in the next year or next 4 years. Again, you're recouping 24.9% on your money every year for 7 years, and you're pretty much recouping your principal back within 4 years, not including any of the tax benefits. Upper right-hand corner here, midterm liquidity. This can be a good use of your slush funds. Some of you guys store your money when you're waiting around for more of the chocolate deals, the higher return type of development deals. A great place to store some of that cash. Maybe you won't have 100, 200 grand to go into the next development deal until maybe a couple of years from now. You put some money in here now, in a couple of years from now, or certainly 4 years from now, you recoup your initial investment at that point, and maybe you might be able to load into that next development deal as all your kind of money gets freed up about the same time. Number 3 here, the Taxpayer fund allows investors to fine-tune their asset risk allocation mix to your customization. So some investors they want cash flow now. It might be a little bit nearsighted, but it is what it is. And especially in times of high interest rates and lack of deal flow, this might be the best thing at the current moment. And what we do know is, at least from my perspective, is you can't just wait till things get good, because once things get good, you've missed out on it already. And you most likely will miss out on the biggest bull run. So the best thing is like just dollar cost average, always investing in something, the best thing at the time, than to wait for those times where all signs point to green here. What we do know now is people will long-term be living in workforce housing and will use real estate. As we saw earlier, there are market cycles that happen, and it is a little daunting for new investors. But if you're able to diversify your portfolio into these different holdings, you're able to somewhat de-risk your portfolio, at least in the short term. But the Taxpayer fund is essentially a tool that you're able to fine-tune your investment holdings, get diversification. And what you're seeing from an investment company from our side is what we're trying to do is offer different types of investments based on what your goals are. And of course, then it's up to you to play with the proportions yourself. But basically, there are some deals that are higher return that take a while to kick in to realize that equity buildup. There are some deals like this tax pile fund with instant gratification. You get this big tax benefit and you get a quarter of your money back the first year. And then there are some investments that are somewhat in the middle of this spectrum, and you need to decide what is your option of these types of offerings. In particular, this offering is mainly the benefit is for those investors who need tax pals for their particular situation. Here on the bottom left, the end game investor, some investors over what I call end game of $4 to $5 million. That's predicated on our typical client of a family of 4, kids haven't yet gone to college yet. $4 to $5 million, typically that magic number that gets people to their monthly cash flow goals. And obviously you want to accelerate to there and then potentially take your foot off the pedal. Some of you investors who live in the more rural parts of the country, lower monthly expenses, may be totally fine with $2.5, $3 million net worth. You may be already an end game investor. And at that point, all you're looking for is to pay your monthly burn rate and, yeah, of course, grow your net worth still over time. If you had $1 million working at 25% a year, that would get you $25,000 per year of income to live off of. Most of our clients, that would be about $20,000 per month. That would be enough for you to living off your remaining days with that $1 million to create that monthly passive cash flow for you. Of course, that wouldn't be your sole investment in your entire portfolio. This is just, again, one small piece of your entire portfolio allocation. This is how an end game investor has different goals. And one of their main goals is to solve the problem. How do I get my monthly recurring revenue? And this is a great place for that. And to break it down a little more tangibly, if an investor put in $104,000 buying up 2 packets of this, that would create approximately $25,000 of income per year. But more specifically talking for the end game investor who thinks of things more month to month basis, that would be a little over $2,100 per month of income. Additionally, for the end game investor, you're transforming your portfolio, selling off all the real estate assets, and or maybe doing real estate professional status in conjunction as you're selling off these assets. What I'm thinking of, somebody may own 4 rental properties that they have a lot of built up equity in, not going to have a lot of capital gains, and they've owned it for a really long time. So a lot of depreciation recapture. One option would be for that person to not work their day job that particular year, which takes some relief off of their top line ordinary income. But also, as they're selling off these investments, transforming their portfolio to employ real estate professional status in that year, and then use the PALs that you get from deals to offset other taxes. And then you would get the tax pile fund would be one ideal source of those passive activity losses. Of course, you have the opportunity to reinvest those returns that you get from the dispositions of other assets to keep the cycle going. But the cool thing about this particular tax pile fund, because you get the money back so aggressively, about a quarter of it back every single year, by year 4, you've already recouped your money back. And if you haven't spent it yet, you could just go ahead and just reinvest it in another project. I think that would be 4 years from now. So that would put us 2028 and somewhere in there. Don't know where we'll be in that point in terms of the market cycle, but I think this is all a trade-off, right? In investors' head. Do you want it now, or do you want to keep playing the game for potentially higher equity returns into the future? The last case here is for the new investor. Inexperienced investors typically join us and they may be pretty green to alternative investments and may not know which deals are best for them. Of course, always, generally speaking, getting into many deals as possible and playing around with some different asset classes is great, especially some that are less correlated with the economy. Nothing really helps than seeing that monthly check come in, which you'll have on this tax pile fund. And then also, especially if you're needing those tax piles to lower your income, I don't think there's anything else that's going to get it more than this particular offering. Another thing, similarly to comboing with your infinite banking, accredited investor banking, a lot of new investors will access the home equity in their HELOC as a funding source. And they're going to feel uneasy with that monthly interest accruing. Now, that's obviously something that most investors get over time, but it can be very unnerving for new investors. And that's where the tax pile fund can provide that monthly income to offset that expense. Again, month 5 is when those checks will start to come out on the monthly cadence to more than offset what you're probably paying on your HELOC side. Basically, the arbitrage there is you're making 24.9% here. And I think most of you guys are paying somewhere between, you might have a teaser rate at 5%, but I think a lot of people are paying 7, 8% on their HELOC, which is a lot less than what you're making in the tax pile fund per month. And then thirdly, we get it, right? A lot of investors may have skeptic spouses. Nothing really helps cure that than pulling up the bank account and seeing the cadence of these monthly checks rolling in from this fund. Yeah, and that kind of brings us to when is enough? What is your number? And this kind of goes in with my whole, mission why I started the Wealth Elevator and educated people as I used a lot of these types of strategies myself to get to the place where I'm at today. Basically, it's a trifecta of investing in alternative cash flowing assets, which unlocks tax advantage maneuvers. And you're getting great returns paid monthly in this fund. But again, the big benefit here is the tax benefit in this particular fund. And then thirdly, third part is infinite banking accredited investor banking, which is the capstone of it. But especially if you're a high income earner, the tax benefits or number 2 here in this trifecta is going to be the biggest bang for your buck or your low hanging fruit and where most investors need to concentrate first. And where does this lead to? When is enough? Here in the upper right hand corner, we have a few end game visions for people who've walked this path in the past, ways to think, what am I shooting for? I mentioned 4 to 5 million as end game for most people. What really comes down to is a monthly, burn rate. Anywhere from on the lower end for our clients, $10,000 a month if you're on that lean FIRE end game. FIRE meaning financial independence, retire early, all the way up to the more fat FIRE, where you're not living an extravagant lifestyle, but it's a nice lifestyle, right? $20,000 of passive income a month. At our last retreat in Hawaii, we lined up everybody in terms of what their monthly burn rate to set up one of our networking breakouts. Nobody in the room was spending more than $25,000 per month. Nobody had bought that Lamborghini, that Ferrari yet. And it goes to speaking a little bit to our investor base, very much prudent people, value oriented. $20,000 per month is a lot of money, of course. If you can get yourself to that level, you can live a pretty nice lifestyle where your investments pay for that. And then you switch from trading time for money to managing your portfolio passively and really having 100% of your time is spent into curating your portfolio with investments as such. To recap the overview, we're going to be going into some questions that you guys submitted here in a bit. But number 1, high cash flow, 24.9% paid monthly beginning in month 4. So approximately, if you're just use some round numbers, if you're going in and just buying one packet, which is $52,000 investment tranche, you're going to be seeing just under $13,000 come back per year, or a little over $1,000 a month on that in terms of your monthly checks. And that means that by year 4, you should have pretty much recouped all your original principal. So that's really good in terms of safety, getting your money off the table, right? There's nothing more safe than having your initial investment off the table and the ability for you to go do something else with it. What you do with it is your choice. You can eat it, you can use it up on a monthly basis, or you could reinvest it into the next investment, or you could load it right into the next year's tranche that we'll have. Secondly, here, I think the biggest thing with this fund and why we call it the tax pile fund is you'll receive a passive loss of 80% of your initial investment in that first year. So it's really big in that first year. And the remaining 20% in the subsequent years up until the end of year 7. The cool thing here is there's no recapture on the depreciation in the end of investment, unlike real estate, right, where you have to recapture the depreciation. And the reason being is after that 7-year lifespan, we scrap the ATM machines and we no longer have them. And if you want to look into the tax code or talk to your own CPA to get confirmation of it, we are using the Section 179, which is equipment deduction on the ATM machines as a mechanism behind it. Of course, if you guys are investing in the 2024 tranche, these passive losses is going to be going down slightly to 60% the first year. But in the overall 7-year lifespan of the holding, the losses should remain the same in terms of totality. Just that first year will be going down a little bit if you invest in 2024. Number 3 here, I'm not charging any fees in types of this fund. This is to compile our investors together. It's compiled reporting. Everything goes very nicely in our portal, and it allows us to go in as one investor. It's always nice if something goes wrong, right? We kind of band together and fight it as a group, as opposed to individual investors procuring their own lawyers. Should things go south, right? Not saying that it is, but it's also something that I think investors need to understand as a potential, downside in any private placement or syndication. That was something that if something goes, I as the fund manager will be representing everybody on their behalf and anything should that low probability chance of that happening, and not charging any fees outside of what you'd be getting by going directly with the operator. So it'll be pretty much a complete pass-through of what the original fund specs benefits going to passive investors. Lastly, I think we're looking at an asset here that's non-correlated with the economy. In fact, I would probably argue that it does well in recessions. And another benefit is that there's no debt associated on the investment. So you can take all those variables of interest rates out of the equation here, which is, I think, great when there is volatility like there is now in the capital markets. Action items here, if you guys are interested, please go to the Syndication Pro portal. If you haven't yet, create a profile, but some of you guys who have already have profiles, you should see the offering live on that page at hui.invportal.com. This is an accredited investor only offering, so you will need to submit third-party accreditation. What we normally tell people is to get a little form letter for us and submit it to your CPA or lawyer to sign on your behalf. It's typically the easiest way of doing that. So reach out to the team for those form letters if you don't have any, and then you just simply upload it to the portal there. Of course, we do accept PRP, self-directed IRAs, solo 401ks, whatever forms of the money comes in, that's fine. Just know if you're investing through one of these retirement accounts, that the passive losses is not going to be able to realize on your personal side there. And that's really the reason why I don't particularly like these supposedly tax advantage accounts, such as IRAs, Roth IRAs, solo 401ks, for example. But again, if you have any other kind of questions and does it make sense to get rid of my 401k, jump on office hours. We can talk more specifically about your situation there too. And just a recap summary table here. We have kind of 2 investment classes. Just depends on when you buy into the fund here, because the big difference is next year, 2024, the bonus depreciation is going to be going down from 80% down to 60%. So that's the main difference, is the approximate losses that first year. The preferred rate of return should stay about the same. Again, whatever the economics at the time is what we're going to be giving. And because the fund is like a 0 fee fund, it's 100% pass through to you guys as investors. The biggest difference there is the losses the first year, but overall in the 7 years, you're going to get all the losses just later on in the time horizon there. But depending on when you purchase your shares, it's going into one of these 2 based on what you're loading into the fund. We're going to go into some issues that you guys submitted here, and then we'll go into some live Q&A. So first, some logistical questions. For the tax side, just want to clarify, $80K on $100,000 losses the first year, $20K in losses the years after. That's correct. Generally speaking, it's going to be pretty close to that number. It might be a little bit better. This investment is eligible for 100% depreciation, which 80% of the depreciation can be realized in the first year, which is 2023. Of course, going down in 2024, with the remaining 20% realized in the rest of the holding schedule, right? The remaining years 2, 3, 4, 5, 6, 7. So that's where the biggest bang for buck is going to be that first year. So for some of you guys sharpshooting exactly how much you need in terms of losses, maybe jump on office hour if we can give you a general idea. But basically what you invest, a good assumption would be 80% of what you put in would be that first year passive losses. Next question, any depreciation recapture in year 7 because section 179, the asset is not worth anything and scrap. So we do not anticipate any recapture on your AT investment because of the minimal residual value of the $50,000 investment to buy an AT machine. The scrap value may be like $500 at the end of it. And that's essentially where this whole not needing to recapture the depreciation that you get, and which makes this particular holding so valuable in terms of taxes. Next question, is income passive or ordinary gains? So the monthly income that you get, the 24.9% per year paid monthly, we consider that and the losses derived from the investment as passive. And it is not a return of capital either. So that actually better than return of capital. So who is the sponsor bank? Who does the audits? So Pathward, previously MetaBank, sponsors and supervises our management company and operations. So Pathward conducts these annual financial reviews and full audits every 2 to 3 years in order for independent ATM operators such as us to use the H networks. And they're supposed to be sponsored by the bank, which in this case is Pathward. So the space is pretty regulated, as you would imagine, as most of these kind of financial networks are. There are finance operation compliance and process systems that are being checked. The sponsor bank ensures regular audits and maintains transparency in their operations to provide accurate financial reports. We'll see these in the reports that we'll see pretty much every transaction that goes through the interchange and just that's their oversight. And then we'll see that on our reporting. Next question, what are the risks? Is there any liability insurance protecting investors? So there is liability insurance, and it's also important to note that investors are a limited partner, meaning that their losses are limited to their initial investment. So very similar to a real estate deal where the liability comes from like tenants. In this case, the liability would be coming from the individual users of the ATM machines, but we're insulated by the property management company and then the investment holding company as a whole. But yes, there is insurance on those levels. And then we are just the passive investors investing in that. Pretty far removed from any type of liability there. Next question, where are the ATM machines placed? Really high traffic areas, airports. If you've been in like the delis in Manhattan, the ones that are shoved in the corner or in the front, multiple other cities, food courts, grocery store chains, small retail stores, multifamily apartments, travel plazas. They're all around. And now that you've watched this presentation, like I said, you're probably going to start to see them pop up all the place. And again, we're one of the top 5 ATM machine operation in terms of portfolio size across the country. It's definitely not a mom and pop operation, which kind of helps from an investor point of view, knowing that we've got a nice diversified pool of holdings here. The minimum investment is $52,000. You can go in increments of that. Next question, do you go into proven locations or do you go into new locations hoping that the spot will perform? So approximately 99% of the time we're going into a location where there's an existing ATM machine and taking over that location. That way we can see the historical data and tell exactly how that location has been performing over the last several years, which greatly reduces risks because we focus on providing premium service to our clients and to ensure that all our ATMs meet full compliance. We replace most ATM machines with locations we acquire with brand new ATMs that we provision with our proprietary software. So the way to think about this is in terms of bringing it back to real estate, like we're going into infill locations where we're going in with a better product. So we're going into a good location, a Class B, Class A area, but we're renovating that unit, or in this case, putting a new ATM machine that has better software, just more newer. As the technology changes, right? That's why these ATM machines only last 7 years. I think in the space, a lot of the smaller mom and pop owners who may own 5 machines or several dozen machines, these are the more speculative types of owners. Can mean great returns for them because they may get lucky and plop that ATM machine down in an awesome location that nobody, us included, know about. That's just not the game that we're in at this point. We're in terms of, like I said, picking the good real estate where we have a running track record of that and build a portfolio off of that type of investment perspective. Next question, should I invest or should I use an entity when purchasing a unit of ATM machines? So most investors will take ownership of this in their own personal name because the ATMs are held inside our fund within an entity, and there's the management company that also carries the big insurance policy on it. This is why investing in your name, this is, I think, why the beauty of investing as a passive investor, right? Limited to little to no liability here, and therefore simplistically to put it in your own personal name. That said, consult your own lawyer, of course, but that's just what most investors will do. Next question, what happens at the end of the 7-year contract? So at the end of the 7-year period, the contract is over and your 84 monthly distributions will stop. At that point, the management company will sell the ATM machines at fair market value. And that fair market value is very little bit. To be conservative, just think of it like $500. Of course, that will come back to investors. And this is one of the reasons why the depreciation is not recaptured. The next question, how soon after I invest do my depreciation start? The ATM orders get turned around the 15th of every month. From that day forward, we have 75 days to order the machines and place them in service. The first full month after this is when your machines are producing, building cash flow. If the 15th on the month is a weekend, this process may be delayed until the following Monday. It's therefore best to assume that there will be approximately 4-month delay between when you invest and when you'll start to receive your first distribution checks. And then that will start your 84 timely month of payments. What happens if an ATM stops performing as well as it should? So the management company is constantly monitoring this. They'll go in, they'll remove the machine, put it in a new location. And of course, no charge to the investor. That's where the pref scheme is really, the investors get paid first. And a lot of these types of risks are taken out of the equation from the investor. And it's really put on the operator to perform the assets, at least up to that amount. If not, the operator doesn't get paid. There will be no lapse or reduction in the distribution amount for individual investors. Also know that you're investing in a blended pool of more than the thousands of other ATMs that you're receiving a blended return. And this is all goes in with the economies of scale and the analytics of having such a wide network and experience of managing the assets in this case, where to put them, where to strategically maneuver, and then writing the contracts of the individual locations. That's really, it gets encompassed within the operation and the property management company. How does an investor get paid? Percentage of profits, percentage of fees. So investors get paid on a blended performance of the entire fund. So everything's pooled and diversified. And in the rare occasion that the fund performance is lagging, the management will share their portion of the revenue to bring the distribution up to the pro forma amount, essentially to hit the pref. In the event that the fund overperforms, the management gets the revenue over the projected preferred rate of return. So this structure de-risks the investment for investors. And I don't know how you can complain with 24.9% a year. Next question, are there no power and rent charges, or are they wrapped up in the overall deal? Yeah, the electricity and all charges are taken care of by our management team, and there are no extra charges to investors. So the 24.9% pref, that's indicative of everything. How long do you have involved in the ATM space? So our group has been involved in this particular investment, I would probably say as early as 2017. The operator management company has been in the ATM space, operating as a fund since 2012. And then even prior to that, in terms of operation with their senior management team. They've acquired other companies, and they're definitely on a growth trajectory, which I think helps us in the long term as further realizing better economies of scale into the future. And have you been hitting your projections? So distributions paid in full on time since the fund's inception in 2012, and check the box, even in COVID, prefs were hit. Non-logistical questions here. So what are your thoughts on the new technology coming on the market that could potentially threaten the long-term viability of need for physical cash? So the adoption of any new disruptive technology typically takes 5 to 7 years to hit its stride. Even risks such as digital currency may take years to start to come into play. And our demographic, which is on the lower end, would resist such digital technologies as they are slow to adopt these new technologies. In the future, you'll start to see new uses for ATMs, and that's where we're positioned to catch the crypto front when if it does happen. And we'll plan to monetize some of these things as the proximity marketing, possibly transferring funds across borders, similar to the Western Union model. We talked about the crypto compatible machines. These are all potential revenue streams and future upside. And one thing I will mention, it's similar to if you've noticed the whole streaming phenomenon, right? Netflix, Peacock, Hulu, and Disney Plus subscription services. All this is a portal for that they have the subscribership. And it's in a way very similar to these ATM machines. In the ATM machines, we physically have in high traffic areas a portal for people to go, for us to sell all kinds of different services. Sure, it's mostly financial services, but we have that physical stranglehold on that physical space in these key high traffic areas. And the ATM is morphing into more of a kiosk as banks shut down more and more branches because they have to hire less costly workforce and manpower because that's getting more expensive. It seems to be very advantageous as an opportunity for ATM operators in the space. And you'll see more and more services perform on these kiosks, which means more revenue for us. And I also say, as I mentioned earlier in this, like the disruptive technology typically takes 5 to 7 years to hit its stride. Nothing is as fast as, man, you look at ChatGPT and AI and how well it writes. That's a very disruptive technology. Authors and writers, copywriters out there. But even that, it's going to take years for that to really work its way into the system. And you're not having the amount of disruption in this type of industry because, again, there's a physical component to these ATM machines as being a portal to this financial services world that, in fact, there's opportunities to grow the position from here. As an investor, we have a shorter timeline horizon here, right? As far as your tax benefits, you're going to get 80% of those tax benefits in that first year. And as far as getting your money off the table, the first 4 years for that. So as long as something doesn't come along in 5 years, you should be in a pretty good place for protection of your principal. Do I think that ATM machines are going to be around in the next 10, 20 years? I would be honest in saying, I don't know, maybe not. But in terms of this particular investment at this time to get the tax benefits that we need this year, that is why I think it makes a lot of logical sense for this. The next argument, and as we dig more into this, isn't the use of cash in decline? No, it's actually the opposite. So what I have here is United States money supply, or known as the M0. So it's true that our demographic, accredited investors, you and me, have converted to plastic a long time ago. But as you can see on the chart, currency in circulation has actually been rapidly increasing when you're considering that along with the fact that the demographic that we're serving, which is the unbanked, underbanked, is one of the fastest growing groups in the country, which is sad. The middle class is becoming the lower middle class. We are experiencing the average consumer requiring cash on a consistent basis for smaller purchases, tips, and other daily services. So here's an interesting phenomenon that I just wanted to propose both sides of this to offer some transparency. Europe is a continent where you're seeing less ATMs there, whereas the United States, it's increasing, which is what we want to see. Europe has a very diverse amount of countries, and therefore they have a much higher demand for electronic currency, which is probably why they made the whole euro thing. So they got rid of these dozens of currencies. But that's also been reason why the ATM machines and the physical cash has been going down. You've seen breaking habits there. Countries like Sweden and Norway have seen a significant decline in cash usage, which results in demand for ATMs and has seen a rapid adoption in digital banking solutions, mobile apps, fintech innovations, and there has been a lead to a decrease in need for physical cash and by extension ATM machines. Another reason behind this is population density. Europe has a higher population density than the United States, meaning that's more concentrated in the cities. That means that a single ATM can serve more people in smaller area, reducing the need for a large number of dispersed ATM or a big ATM network. Many parts of our customer base in the United States live in more sort of rural areas or outside of the major cities. And this is why a fundamental difference between Europe and the United States. In Europe, in terms of banking branches. Banking is still very banking branch centric. People prefer to visit bank branches for their transactions. And this can reduce their reliance on standalone ATM machines, which is the complete opposite that we're having in the United States. Where for economic factors, the economic conditions and banking regulations in Europe, countries can influence the number of ATMs. For instance, the countries with economic challenges might see a reduction in ATM installations. As far as infrastructure, the United States is vast with many rural areas, and in such areas, ATM might be more prevalent as a convenient banking solution, whereas in Europe, even in rural areas, might be closer to town centers with the walk-in bank branches. Number 6 here, regulations. European countries might have different regulations regarding ATM machines, which can influence the profitability and therefore the number of ATMs and the pop-ups of ATM operators like ourselves who can create a long-standing sustainable business around it. Stricter regulations on ATM machines is what you see out there. And then finally, number 7 here, banking consolidation. Europe has seen a trend of banking consolidation where we've seen smaller banks merge or acquired by larger ones. This can lead to a reduction in the number of ATMs as merger banks might rationalize their ATM networks to reduce costs. And one thing I'll add on to this too, in America, you're seeing a lot of the big banks drop the portion of their business, which is the ATM operation. So this is where operators such as us, we come in, we grab that market share that's been vacated by the big banks. And again, they don't want to operate it because of the more hands-on operation, which we're not afraid to doing because obviously we get paid for that, right? There are returns for us to do that. But very similarly to like large big REITs, they don't want to own Class B and C assets, especially with needing to go through rehab, because they're just not looking to work that hard, even though it may mean better returns. The banks want to focus on their core business, and the trend is that they're shedding these ATM services off of their brick and mortar sites into folks kind of third party like us. So when I first started to look at this offering many years back, I got confused by the whole thing because you hear 24.9% returns per year. Sounds a little bit too good to be true. And I wanted to be really transparent with why you go into this investment. You go in for the tax benefits primarily. The returns that you get, pay attention here. So the way to think about these ATM machines is think of like an oil rig. For anybody, a lot of people in our group will invest in like oil and gas deals or be aware of them. But essentially what an oil and gas deal is, it's a hole in the ground. It's an oil rig that might cost a few $100,000 to put into production. And you're hoping that you strike oil. And even if you do hit oil, that oil rig is only in production for, say, 5 years, or let's just say 7 years in this case, to mimic an ATM machine works. After that 7-year period, there is no oil in the ground, right? You just have to scrap the materials and bury the oil rig and move it to somewhere else. And in a way, these ATM machines sort of work in a similar manner, different from real estate. So here on the left side is how the cash flow profile and exit that pop at the end works for real estate, where if I point out here on the y-axis, you have the returns, and then here on the x-axis, you have the time and domain in terms of years. And you're seeing the cash flow kind of starts out, maybe not right away, but it eventually starts out and it comes out and you make more and more returns. But the majority of returns, especially in a value add multifamily deal or any commercial real estate value add deal, is that pop at the end. When you finally sell, you cash in all that hard work, that NOI bump, and you sell and you exit. That's where majority of the returns are coming from. Whereas in this particular investment, the cash flow, it starts 4 or 5 months in and here, and it's consistent at that 24.9% per year for 7 years or 84 monthly payments. However, unlike the real estate, there is no pop at the end. These ATM machines are pretty much worth nothing at the end. There are some salvage value that we'll get, but effectively speaking, it's not really worth anything at the end. So at that point, there is no pop at the end, whereas real estate. So it's just important to understand this, that once you get your 84 monthly payments, That's it. There is nothing to come out of the investment because the investment in itself, the ATM machines are essentially scrapped and not worth anything and sold. Now, that was in terms of cash flow. And now I want to look at in terms of passive activity losses because investors need to understand that this needs to be a big thing of why you're investing in this tax pile fund in the first place. So in multifamily value add real estate, you'll get this nice pop of passive activity losses that first year, and then it'll eventually go down to a much lower level, which I guess it really does mimic the ATM machines too. However, I think per dollar invested, you're getting definitely a lot more than what you would be in multifamily real estate. However, with multifamily real estate, what you have to understand is all those cool passive losses that you got in the first year and subsequent years, you have to recapture that thing. And you also have to pay the taxes on that returns. So not only the recapture, but you have the capital gain that you have to pay taxes on it too, that I don't really have captured here. Whereas this ATM fund investment is very tax efficient. And this is why it helps out on your other parts of your financial picture. Because in year 7, we don't recapture these losses like how we do real estate. And as you're getting the cash flow through the 7 years, that's effectively being canceled out by your passive losses that you're getting. Of course, consult with your own CPA if you need extra additional understanding on this. We're here to talk you through this so you have a true understanding on how this works. But I just put these 2 slides together to help you mind map and get a good grasp on exactly how does this differ from multifamily real estate in terms of cash flow, and then also in terms of the tax benefits to this. And now you can see, because you don't have to recapture it at the end, and especially because there is no capital gain at the end from a big pop, you're seeing how this is exactly why we call this the tax pile fund. And now maybe you have people in your network that really need this types of thing for their taxes. Again, feel free to connect us via email. We'll get them plugged in with a lot of this information. We need to have them go through the onboarding process, of course, but people in a certain situation, this can be quite the game changer. But as I would say, diversify your portfolio with different assets and different purposes because everybody's in different situations, right? If you're a guy who makes over $500,000 a year, you're doing rep status, man, you're going to want to gobble up holdings in this tax pile fund. Whereas if you're somebody who makes less than $360,000 married file jointly, and you have passive losses already from your other multifamily deals, then the benefits, especially on the tax side, isn't going to be too much leading you towards down this investment. And you're just going to want to go into some of the other offerings that we have that are more based on equity growth and or cash flow. So again, very kind of being very vague there, like everybody's in different situations and you need to understand what's best for you. I mean, we can help you, walk you through your situation, but ultimately you're going to have to take ownership over this and work with your own team to decide what's best for you. I'm going to read a little bit of this disclaimer here, which is this information is authorized for the use of a limited number of persons within an existing relationship within the Tax R1 Growth Fund LLC. Neither the Securities and Exchange Commission nor any state securities commission has approved or disapproves of the real estate interests in this property package or passed upon the adequacy or accuracy of this document. Any representation to the contradictory is a criminal defense. This material does not constitute an offer or a solicitation to purchase securities. An offer can be only made by the private placement memorandum. This document is an informative summary and is authorized for the use of investors or prospective investors with an existing relationship with Tax R1 Growth Fund LLC. The rates of return discussed throughout are only projections and not guarantees of any sort. Actual returns may vary widely due to many economic and marketplace factors beyond our control and are also subject to change without market conditions. All information shared is confidential. Please do not distribute without permission from Tax R1 Growth Fund LLC. And I'll just also end, we try to keep these things confidential. However, if you guys would like to share it with a friend, maybe somebody out there needs passive losses, please just let us know, have them sign up for our club, and you're welcome to share this material to them privately. This is the follow-up live question and answer to the original webinar. The investment that we're talking about is investing as a group Altogether, we go in as a larger entity, and this allows us to all stick together. If there's anything to happen, I'm the person to take charge and lead any type of a large class action type of lawsuit on everybody's behalf. And I think that's what's the hard thing, like being an individual LP, when things go wrong, it's difficult because there's a lot of legal costs and issues, bandwidth on your end if you have to go down that road. Hopefully, people never ever actually have to do that. But in this case, by investing alongside of us, we all kind of stick together. But the investment here is investing in a diversified pool of ATM machines. The investment return standpoint, 24.9 returns. The investment tranches are 52,000 sizes. So you can do 52,000, $104,000 and increments of that. Somebody asked a good question. Hey, can I put in like half of that or $74,000? And I didn't think of it, but actually within our fund, we may have the possibility to do that. So if you guys are interested in doing kind of like a half size portion in above what you're doing, let us know, let our team know, and maybe we can pin you with somebody else and buy it as a fund, as the $52,000 tranche. But in a $52,000 tranche, the annual pref returns would be this much. And this would be paid monthly, which I know was a big thing for investors asking. They want that monthly reoccurring cash flow so that they can maybe pay off other lines of credit, or maybe they're comboing it with their infinite banking, accredited investor banking there. But those payments start about the month 4 after you do it for about 84 monthly payments. So you're essentially got your original principal back in year 4, and then those payments go out to year 7. So that's one half of why you would do this type of investment. The other half, and what I actually think is the biggest thing, is getting the tax benefits here. So right now we're in a year where it's 80% bonus depreciation. It'll go down next year. So that's why I say the better to get into the fund sooner than later. So $52,000 investment, about $41,000 of first year losses. And these are passive losses that, of course, consult with your own CPA. If you guys need a referral to a good one who's not going to gouge you, that understands all this type of stuff we're talking about here, shoot us an email, we can connect you. But you'd be able to get these passive losses to be able to offset maybe you're selling off other rental properties, maybe you had a syndication deal go full cycle to offset other passive income. And some of you guys are doing real estate professional status and may use this type of investment to not only get great returns on the monthly basis here, some of you guys even talk about driving your AGI not to $360,000, but almost to zero and pay no taxes legally with this. Again, like investments are tools. Everybody's got a different situation. And I don't want to get into personal situations here. We can talk, you guys can come to office hours, or you can just talk directly with your CPA, or we've got recommendations on CPAs here. But I think that's the big thing for this fund here. With that, I see a few of you guys have put in some questions. So I'm going to try and cut and paste some of these questions here. Oh, somebody sent a question in. What does the reporting look like and what is the cadence? Once the fund gets going here, the monthly payments will start to go out again after that month 4. And we'll send out monthly reporting with that too. How that will look, it'll be a real summary of the number of transactions that the ATM machines had, and then the revenue that we got from that, and then the number of ATMs in service. So that kind of level of detail. And of course, the important thing is what is your distribution? Number 1 here, can I suspend the bonus depreciation, use it a year other than the year it was issued? For example, can I suspend the 23 and use it in 2024 when I sell a property to offset depreciation, recapture, and capital gains? I will say, obviously, disclaimer right at the end of this, I'm not a CPA, not a tax attorney. These are passive losses, and any passive losses, this is what I've personally done, any passive losses that you don't use up become suspended passive losses. And you can find this on your 8582 form, or simply ask your CPA. It shouldn't be too hard for them to look it up. But you carry these things forward. So if you went into this fund now because you're like, this year for 2023, it's obviously a little bit better first year losses. If you came into this fund into 2024 Some of you investors may be slow or waiting for liquidity events. Some of you guys are paying your taxes. It's too late for 20, but maybe you come in 2024, it'll be in a different tax year. When that comes around, assuming the minimum investment is the same, the first year losses will be less because the bonus depreciation is going from the 60%. But you'll eventually get those losses later on, right? As you can see, the approximately first year losses after the first year. But that first year, time value of money, it's better to get the losses first in the beginning if you're going to use it at that point. But it would make sense if you've got cash right now and you're trying to get as much passive losses and get it this first year, then if you load into 2023, you get a part of this tranche now, then yeah, you could seemingly save it for next year when you do sell off other rental properties. Then going into the 2024 tranche, and then it's a little bit lower first year losses. But as far as the next question, I think the answer to this question is essentially whenever you load into the fund, say you come in now in 2023, you're going to get that on your 2023 K1. I'll take you guys off mute if you guys want to ask follow-up questions to this. How is depreciation recaptured this year?
I was asking too fast, actually. I saw your table. We're wondering what is the depreciation and how you guys come up with the 80% and 80% first year. But yeah, in that table, yeah, that one. You got year one, you get 1 year, year one, year two.
Yeah, so this is what you're going to get your first year K1, B23, and then 2024, 25, 26, 27. It's going to be this 10,000 split apart in those subsequent years that would sum up to 10,000.
Okay.
So again, it's just estimates, but if you're splitting that 10 grand over the next year, 2, 3, 4, 5, 6, 7, maybe $1,000 of losses the year after, for the next several years.
Okay. So while you're here, the investment 52,000, and can anybody put in a different amount, more than 52,000?
Where the 52,000 comes from is that's like the fund is supposed to buy ATMs, right? And when you add in all the soft costs and hard costs, it's like 52,000 per ATM. So that's the reasoning behind that. But as I started at the top, I suppose if anybody you want to maximize the amount of losses that you're getting and you got an extra 25 grand, maybe just let us know, and maybe there might be another investor that has 25 grand, and then together we just account for it and we buy one as an extra one on the fund. At the end of the day, we're splitting everything equally as the fund to all investors anyway. But just let us know. But generally speaking, investments are in increments of $52,000.
Okay, good. Yeah, thank you.
Question here. So am I understanding this correctly that this is mostly a tax play since the annual return is about 10% annual returns on top of the return on investment? Yes, that's correct. It's nice that you do get it starting pretty quickly and on a monthly basis, but this is again why we call this the Taxpayer fund, because the big benefit, or we're expanding the pie for everybody, is the tax benefits here. So if you're somebody who doesn't have a need for passive activity losses, or if you're not doing real estate professional status, it may not make sense. Although I don't know what other investments out there that can reliably get you 10% annualized returns anymore these days, especially in this high interest rate environment. And of course, I think speaking for all investors here, you need to diversify, right? You can't just be looking for multifamily apartments or mobile home park. You have to have a diversified portfolio. But those investors who are in those higher tax brackets and you're able to use these passive losses to their maximum ability, if we had an investor bringing their adjusted gross income, a delta of 500 grand of AGI difference, effectively saving them almost $250,000 in taxes, I don't want to market this investment as, I'm not going to call that investment returns. To me, that's misleading. But if you're able to get passive losses from this type of investment, to get that, you have to also factor that in. Obviously, everybody is in a different tax situation. As the saying goes, your mileage may vary. So you have to do the math on yourself. The cool thing I just want to point out where this is different from any real estate deal is depicted on this slide here. Where in a real estate deal, you have to recapture those losses at the end, right? Some investors, like they invested 100 grand and they got $120,000 of passive losses that first year. Whenever that deal exits, you have to recapture that amount. Where in this case, we are using Section 179, and at this point, the ATMs, the asset is essentially scrapped for almost nothing. And therefore, that is the reason why we don't have to recapture these losses. So that is a huge benefit. It's not just simply deferring a taxes in a way. But what I would do is obviously get with your CPA and make sure you understand, you run your due diligence. But this is a way that many of our investors have used this as a tool in specific years. And just the last gentleman, he knows he's selling a couple of properties next year. He's got huge recapture on that one and probably a big gain on it too. These losses are going to help offset that in the future. This is why we bring up this type of investment in October, November, December, because this is the kind of the time when most sophisticated investors, they know how much losses they have and they're trying to bring their AGI back down to earth. And this taxpayer fund is a super effective way of mitigating that particular part of your financial picture.
No real follow-up questions. Just I'm in a situation where I have a ton of losses already. So I don't know how long it's going to take me to catch up what I already have. So that's why I was looking at that. Although your point is well made that 10% right now is a pretty decent return.
Yeah, it's not bad, but I'm in the same situation as you, right? Like I've invested, but I got oogles and oogles of passive activity losses. Not many people are in that type of situation, especially the people playing rep status where they keep driving their income to almost nothing every single year after year.
Right.
But everybody's in a different tax situation. And what gets me excited about all this stuff is we open up opportunities, these new ideas to people. And now it really empowers people to pay whatever they want legally on taxes. But part of this is just education, I think. But
I think to reemphasize your point, that's also very appealing is the non-recapture down the road. I gotten stung with that before. So that's a really nice point.
yeah, I would say it sounds like for you, this may not be for you. Like personally, from an investor perspective, like I go into deals sometimes as in passive LPs, try it out so that when I know I need it, it's not something brand new. It's not a concept, right? I think that's why some people join the family office group so that you have people around you who've made the mistakes or trial and error things for you. But yeah, I guess the example I'm thinking of is like oil and gas deals. I went in oil and gas deals maybe 4 years ago. As I said, I have oogles and oogles of passive activity losses. I wish I could sell it to people, but oil and gas deal was new to me. And I wanted to really see how those IDCs impacted my tax profile. And you don't learn anything unless you do it yourself and see how it goes through the pachinko machine on your taxes. I tried it out but yeah, I would highly warn people against oil and gas deals. Man, there's just a lot of cowboy operators that do any kind of things, and it is very speculative. And the tax benefits aren't really that great, in my opinion, nowadays. Same thing with conservation easements. Before, a lot of our clients would do the conservation easements, but with the omnibus bill, ooh, that's a little sketchy. And that's why there was such a demand for this tax pile fund, as you can see. Next question here, Michael's question. Will we need to materially participate in this activity for a rep to use these losses, right? Again, I'm not going to play CPA or tax attorney here, but from what I've seen from other people, when you're a real estate professional status, now my understanding is now everything is now ordinary losses. So therefore, the passive losses you be getting here or losses that you be getting here as a rep would now be able to be used on ordinary income. Does that make sense?
Hey, Lane, at least not with the CPA that I work with. So my understanding is that we can't unless we do something called like a grouping election.
Yeah, and that is what needs to be
However,
done. Exactly. And that's where you need to have the conversation. Have you ever thought about grouping all your investment activity together? A very common thing here. And most times the answer is just get a new CPA. If you want a referral to one, maybe reach out. But I would say at least have the conversation and interview some other people.
I'll ask my CPA.
I can already tell where that conversation is going. People see it one way or the other. It's one of those things with CPAs. It's either you interpret the whole grouping, how far you can take it. Some people take it very liberally, And it's what I see a lot in our world. But of course, you're stuck with the service provider you have. But I would just say interview multiple people, because at the end of the day, they're the one who's going to have to go at bat if you ever get audited.
Okay.
But yeah, if you need
Yeah.
just shoot us an email, team@thewealthelevator.com, and at least you can get another opinion. I think a lot of times what I notice is like kind of the way you start to ask, right? Hey, can you explain to me about this grouping thing? And then you take it from there, because most times if a CPA is just not familiar, they're going to cut you off in the beginning. That's the trouble, right? A lot of these like professionals, they have long-standing businesses. They don't really need to do things the hard way, the off the beaten path way that we do it. They just do it the way that's easiest for them, despite having a good reputation amongst people who don't really understand this type of stuff or don't push them to this point. But next question, what is the deadline to invest in 2023? So as long as you go into the fund and the asset is purchased in 2023, that is what qualifies you for this 2023 tranche year. Right. Of course, the 2024 tranche is going to be lower because we already know what those rates are going to be. As far as what the preferred rate of return is, it will probably be pretty dang close to what it is in the 2023 tranche. And the only other caveat I would say to the deadlines, the ATMs are submitted for order in the middle of the month. What we are going to do here on our side is we're going to call the 10th of the month as a cutoff. If you don't wire your money that it settles prior to that, unfortunately, you're just going to have to wait for the next month for it to go around. Please do keep that in mind and try not to wait to the very end. I know some people try to do that and it's a little silly. It's egg on you if you are cutting it too close. At the end of the day, 84 monthly payments, it doesn't really matter in the long scheme of things. But just be mindful of those cutoff dates. And I think the big one that question is alluding to here is just make sure you get in, I would say, prior to that December 10th to be assured that you get into that 2023 there. Hey, Vince.
Hey, good afternoon, Lane.
Hey, how's it going?
Going well.
Right,
Thanks for taking
yeah.
my question here. To the first point that Michael was making about the annualized return of 10%, I just wanted to follow up with that. In order to do the tax piece of it, and I realize you're not giving out tax advice, but just another question, there is no return of capital throughout the 84-month payment, and obviously no return of capital throughout the 84 payments. The passive income that's going to be received on distribution is really from start to finish, whereas there's no return of capital offsetting that. So in other words, just from a tax, trying to figure out the tax calculation piece of it, that part, as far as no return of capital, it's just going to be passive income all the way from start to finish, correct?
Yeah, so that question did come up offline or earlier. Like somebody was like, "Was this ordinary income or is it passive income?" It should be categorized as passive because you are a passive investor here, right?
But what I'm saying though is the 24.9 all the way through. In other words, there's no return of capital offsetting that. In other words, the entire amount from start to finish is going to be passive income or just income. I realize it's passive versus ordinary, but my point is the entire amount versus if you were looking at, for example, a syndication or a real estate deal, some return of capital or capital event is going to offset that, or there's not going to be any passive income on that amount throughout the 1099 or K1 payments throughout the duration of the payments. So for example, if you were looking at, like you were showing in the video, a real estate deal where it's a value add deal, there's obviously a return of capital event that is going to be, when you do the calculation or do the math of the 24.9 and you analyze it, it's really about 10% because of the fact that there's no return of capital. When you're, let's say you pay in 52 or 104, if you're doing two tranches or whatever it might be, those distributions are all passive income all the way from start to finish. Whereas you're looking at a value add deal, yeah, you get a return of capital where they're not getting taxed on that particular amount. Your initial investment amount is what I'm talking about.
So yes, it is considered passive income, which is better than ordinary income, but it's considered income. But again, like it's a moot point because you got so much losses in the beginning that you're not really making any type of taxable net profit until after year 4, right? You know, and then at that
I just
point,
think I just think the difference in the distinction when you're using the two examples of a value add deal versus this is it's passive income, I should say, all the way through from start to finish. Whereas on a value add deal, your return of capital is not taxed.
That absolutely never happens in any type of real estate deal, even though in theory they say, yeah, we're going to do return of capital, just giving you back your own money. But that never happens because as an equity holder in any real estate project, you have an equity stake or percentage stake of the profit and loss. We're talking real estate deal. And this is what some investors don't understand. Sure, say you got $10,000 of distributions. Some investors think, well, like, hey, I should have $10,000 of distributions. Absolutely not the fact. There is this thing, if people want to Google the definition of phantom income, whatever your percentage is of the deal is what of you take of the P&L of the large deal, right? So it could be very well that the investment might have made 10x that, but they may have not distributed to you as an investor. And this is where a lot of times what really happens when a multifamily deal, whatever kind of real estate deal goes through, is that return on capital gets greatly trumped by this internal income that's happening on the deal level that gets pushed to investors. So as much as they say that it's return of capital, it's trumped by all this phantom income anyway. But
yeah, totally understood. And my point or example or question ultimately was the same. It's basically the same thing. Ultimately, in this investment, it's going to be income all the way from start to finish because of the way it's structured and because of the tax loss or the tax pile that's coming along with it. In other words, that 10% annualized, if you were to look at the fact you're receiving distributions regularly, monthly, those are all coming in as income. There's no phantom income element and or capital event at any future point in time.
Yeah, like in a way, I'm not going to say there's no phantom income. I can't say that. This one's really simple in a way. Like you don't really have
Well, I think
to
that's a better
worry.
way to say it. I agree. It's not going to be recognizable phantom income because it's going to be straight distributions that are basically taxed as passive income, is my point. Whether it's taxed or not, it's irrelevant, but they're coming through straight from start to finish as income versus a capital event, which wouldn't be coming across as income.
Yeah, and I think if people are confused now, don't worry about it. Like we're talking about more of a multifamily, like any real estate deal. This always confuses the heck out of new investors. Return of capital, return on capital. What is it? I hear, what is it, Vince? Return of capital is better, right? Because you're not taxed on it. And investors always once they start to hear this, they always ask the question. But in reality, guys, when you're actually in more than a few deals and you see how this stuff actually works, you start to realize the phantom income more than trumps that anyway. And then you're in a few deals and you don't care in real estate deals. But that's what we're talking about here. But in this case, it's just super simple.
Yeah, I agree. Thank you.
But yeah, you're aware of that now, right? You see what actually happens, and after a while, you don't care. After a while.
Yeah, 100%. It was just making a distinction between, as you put in the video, a value add deal or a syndication deal or whatever it may be versus something like this. It's simpler and it's just a simpler way to look at it as far as how it's going to come through.
And in case people weren't following earlier, like you take these 84 payments, these monthly payments, and this is just summed up by year. You made $90,000 on your 52 grand, but you got to back out your initial investment, right? Because the ATMs are scrapped and not worth anything. That's where you go 90 grand minus 52 is about 40. And then you divide 40 by the other 7 years. And that's basically your real return, which isn't great, probably more than what most people get out there. But again, like you got to factor in these tax benefits, and it's going to be a different case for everybody. And this is if you want to conceptualize this in real estate deals, supposedly you have cash flow, right? That's a funny thing these days, inflation. But then you have this pop at the end. And then you have the pop at the end is the asset is sold. But in this case, this is how the returns look from, it's just 84 straight payments paid monthly and not quarterly, monthly. So that's nice. But at the end, it stops. So you have to account for, if you want to normalize it and compare apples to apples in a way with normal deals that we're used to, you got to back out that initial investment. And that's exactly what Vince and Michael were talking about earlier. So the question here was, I'll let you come up, Justin. I hope you watched the webinar prior to. We talked about this for 15 minutes. That's okay.
No, I didn't see it.
What the heck, man? You gotta watch the. Nah, I'm just giving you a hard time. But yeah, we talked about that in the first video, right? The strength, weaknesses, opportunities, and threats. The people using these ATM machines are underbanked kind of sector of the population. ATMs are going up. The money supply is going up. Sure, there are some threats on the digital currency and stuff like that. These ATMs are programmable hardware, right? So it does have the ability, and it is on the radar to, if things do change, to have that be a revenue source in the future.
Mhm.
But from now, the way I look at it personally, when I'm investing is this one is, do you think things are going to drastically change in the next 4 years for me to recoup my principal back? I don't really think so. Maybe in 10, 20 years, potentially. But this is why the return of principal so early, so quickly is critical for security and to alleviate those kind of threats. But that said, it could be a big opportunity to further stabilize the asset by taking advantage of these new Bitcoin enabled technology on it.
Yeah, this is something I was looking at buying my own ATM, and the return time on it was about 2.5 years. And for the Bitcoins, which are more expensive, it was about 3.5 years. The only issue was that they were not, it was an either or scenario. There weren't that Bitcoin programmable cash ATMs right now. So you either have to choose now or get stuck with what's going on now. So that's why I wanted to know if there was a contingency, at least in your mind, before we got into this fund.
Yeah, that's why the sooner the better, right? Or get your tax savings too in the process. But those types of trends, it's always being talked about, futurists. They're always talking about flying cars, but that never happened. Again, we're talking about the lower third population here using these ATMs, the underbanked. But it's funny, we have some definitely scrappy investors that flip homes. And I don't know if you saw that really old podcast I did in 2021, where one of our investors actually did do that, what you're saying. I think he had 4 ATMs back then, but before that, I wasn't really aware of this type of business. It's definitely a blue collar type of business, which I tend to like. But maybe Justin, go check out that podcast back in 2021. I think the link, here's the link. Yeah, podcast number 268. So if you go to the YouTube channel or you go to the website, you can probably find it. It was on August 31st, but we had a gentleman who played around with it. But the difference there is like the mom and pop investors, there's a liability there. They're not as insured. They're the ones literally running around with the cash, right? Where this is, as an investment group, we're moving more towards stable, less mom and poppy type of investments. If people have been around with us for a long time, I remember doing like little 50-unit pieces of junk, Class C properties. And then we moved away from that. And now we build like brand new developments. I was also getting involved with larger and larger players, getting more in that family office level. Sure, returns may go down a little bit, but in my opinion, at least speaking for a lot of our accredited investors and qualified individuals, over $2.5 million net worth, we've maybe put a little bit more emphasis on reliability. And we had a question here, how many machines are planned to buy? We're talking like thousands here that is currently in the portfolio now. But by all means, Justin, man, it's definitely a business like this, vending machines or car washes that some people will do and be their little mom and pop owner, little coin operated laundry businesses, and running around with $5,000 in your pocket, looking over your shoulder, filling the ATM machines. But in this way, we're really doing it more on an institutional level with professional operators. And I think a big part of this is there's a barrier to entry with this ATM thing. You really need to get to a scale where you have that banking relationship. We're working with the 4th largest ATM operator in the country. So certainly not a mom and pop operator. And I don't know, Justin, like when you start to look into this stuff, are you the one who is getting the banking relationship, or are you going through kind of one of these third-party servicer who brings you guys into it?
Yeah,
Like,
I was just gonna say I had to go to several banks because it's a certain, I think, money cash business exchanger designation you have to get with your bank. Yeah, I didn't get past getting a bank account that I could qualify to run the ATM business from. That was local, so I could do the cash drops and stuff and not have to go to the other side of town.
okay. Maybe that's a good sign that not anybody can just go and get this, huh?
But yeah, it's definitely a little
Not
bit to
yet.
entry too.
Yeah, barrier to entry.
Yeah, I like this fun.
Yeah. I guess that makes me feel good that not anybody can just tap into the ACH networks that is built on all this stuff, suppose. By all means, I love the whole entrepreneur spirit. Just watch yourself when you're filling those ATMs by yourself. But I will say there is a difference between, I think, your guys' business plan. Like my understanding with the small mom and pop operators is you guys are going after virgin spaces, like newer places. And that's a lot of your guys' value add is to negotiate with new storefronts where, hey, we never had an ATM machine here. Would you like to have one? We'll do this revenue split. And that's a lot of the mom and pop investor side, where in this case, in the fund, it's going after more sort of blue chip type of ATM placements. So existing ATM in places where you already know what the run rate is. So sure, you're not going to hit a spewing oil well with one that nobody knew about. But again, it's going more for reliability. And
You can, if you get a trailer hitch mobile ATM, park outside a event venue, concerts, that kind of thing, those can run you like 60,000 a night.
in this fund, it targets, the perspective is to target existing places where there's backups on the throughput on it already, where I guess what you would be going after would be more exploratory, to use the terminology from that one time I went to the oil well and actually learned about this stuff before I invested. Exploratory drilling as opposed to more stable. If somebody has the words, please let me know what this means in the oil and gas industry. But it's just a different type of investing. At least I know, like for multifamily apartments, Class C apartments, yeah, you can make a good amount of money doing it, but it's risky, right? Especially investing in tertiary markets. Whereas it's quite the opposite in larger apartment complexes where you're in major secondary markets like Dallas. It's not like you're going to get an amazing flyer deal from a stability standpoint. It's just a little bit more stable. And that's the prospectus of this fund with amongst pooled of so many assets. But it's like the difference between, are you a blended whiskey guy who likes the smoothness, or are you like a single malt Scotch whiskey who likes the individual barrels, right? You think, Justin, you're a wild man who likes to live on the dangerous side, and you will be rewarded and you will be hurt sometimes, right? If you're serious about going down that road, yeah, maybe I can connect you. Should me, but with that one guy. I don't know if he's still doing it. Or, it's funny. It's like turnkey rentals. It's funny how time flies, but the people who we helped buy turnkey rentals a long time ago are going full cycle and now wanting to sell them. So maybe he wants to sell them at this point. He's tired of it. If Roth dollars, or I'll just say all qualified retirement plan dollars are used, are those losses still available? My understanding is, yeah, you'll still get it on your K1 form, but you can't really use it on your personal side, which is the whole point. And this is again why my big qualm against all retirement plans, qualified retirement plans in general. If you want to hear my whole spiel on that, come to office hours. Of course, it's every personal situation is different. And if people are new to this, you need to start to catch on to the idea what the cool kids are doing and using their passive losses to knock out their passive income from their other investments, and in conjunction with rep status, possibly lowering their income down with this. And to do that, you need passive losses to start to play these types of strategies. If not, you're just doing the same lame tax strategies that the CPAs talk about, which is 401ks and Roth IRAs, which is essentially just deferring taxes. It's a lame tax mitigations, at least in our world. Yeah, you can use your Roth dollars and you'll get the pref returns, which, as we said earlier, isn't too bad. And I think it's great if you're outside of our world. These are great returns without the tax benefits, but you use for the tax benefits. And that's why we call this thing the tax file fund. But here's where I'm going to go off on a limb, Jeff. Another reason why I don't like any of the qualified retirement plans is you got these like UDFI, UBIT stuff, where you have to pay taxes on the leverage portion within your IRA. I would speculate, and I'm going off a limb here, that if you're getting the passive losses, sure, it can't come to you personally to do all these cool things we're talking about here, but I think you can use those losses to offset some of the UBIT tax within your IRA. You can't bring these losses that you get that we're talking about here. You're investing as your IRA. It can't come to you, help you personally. right? But I think it can stay within your tax sheltered account and offset. Maybe you're in some other deals that are utilizing debt.
Yeah, I am in some other deals utilizing debt, and my cost segregation losses are running out on some other deals. And so I am looking for some loss in that regard.
Oh, okay. Okay. So I think that's a good sign, at least the way I see it. So this is all within your IRA, right? And you guys had some losses in there, and that is offsetting that UDFI tax. I would say in similar fashion, it would be doing the same thing, but in your IRA.
If I had to do it all over again, I would, knowing what I know now, I wouldn't, as you've said so well before in the past in podcasts, I wouldn't have done a self-directed IRA. I would have just paid the tax on it and paid the tax on at the beginning instead of have it grow so big over all these years and have it be just losses that are taxes that have to be recaptured on this income.
Yeah, I can't say I didn't tell you, but I think in your defense, for a lot of new investors to take the money out of the IRA accounts that you work so hard to put it there in the beginning is hard. So I get the whole thing of trying it out within the IRA. That way you can, if it didn't work out, then you can put it back into the IRA because you never took it out. But in that case, what a lot of people will do is they'll do a solo 401k, which in a way it's just like kicking the can down the road or punting the football. And then once they get proof of concept with these alternative investments, then they withdraw it out. Of course, when you withdraw it, you got to pay that silly 10% penalty, which isn't very much. But the bigger thing is you got to pay income taxes. So you got to mind where you are in terms of these tax brackets. But yeah, you guys can do whatever you guys want, right, out there. But if you got cash, use the cash for this type of investment as opposed to IRAs and that type of stuff.
Yeah, I am a solo 401k, and that helps somewhat with the UBIT taxes.
Yeah.
Still, the gains are, I think the gains I'm going to realize when some properties sell would be regular income. I could be wrong. I don't think it is capital gains rate.
So, sorry, say that one more time.
I think that the gains I get inside the self-directed IRAs are distributed as personal income, regular income, rather than capital gains income.
Yeah, you might be right there, right? So that's even makes it even more so just to take it out sooner than later. That way you're able to get somewhat of that tax efficiency thing going. And I think you're right, but I'll be the first one to admit, like when you start to talk about that type of stuff, or when deals exit and you're able to pay less taxes on recaptured depreciation, we've got a webinar on that where we talk about it. I just sent it to another investor. It's around minute 19 in that video, but I'll be honest, that's where I'm like, get the CPA who understands this stuff involved, but just know that there are slightly more tax efficient ways as a byproduct of the way we do things. You benefit going with the grain on some of this stuff. Anything else there, Jeff?
No, thank you very much.
Yeah.
It's a pleasure to be involved in this podcast.
Looks like we've reached the end of the questions. I would say if you're watching this later on, make sure you guys see where we are in terms of like when is the commits coming in. This is an accredited investor only investment. So if you're new to the portal, you've got to upload your third-party accreditation form, which shouldn't be too hard to get, especially if you just get your CPA or attorney to write you a nice little form letter, which we can help you guys out with a generic version of that. But because of the know your investor laws, like the SEC doesn't want, I don't know what they're trying to do, but they probably just don't want foreign laundered money coming into the country. You've got to do the whole thing where you take a picture of your passport to verify with your identity. So there is those additional steps I do notice that's all done securely through the portal. But it takes a little bit to go through the portal, which if it's your first time, it can be a little bit difficult. So don't be afraid to just reach out to the team, shoot us an email, or just pick up a phone and give us a call. But be mindful of the cutoff dates. And then if you got a question on when that is, just shoot us an email and then we'll try and bird dog your investment to make sure you get it in the right time. But with that, thanks to everybody for coming, and we will see you guys either on the office hours where we can dig more into people's personal situations and maybe see how this might benefit particular cases. And yeah, thanks everybody.